Sadly, many silver bugs, as I say, are manic depressive. If the price of silver from a $24 base rises to $2, they become rhapsodic. If it falls from a $24 base to $22, something's wrong with the world. Something, in fact, is wrong with the psyche of the silver speculator. He or she needs to understand that the circumstances which would set a bull market off can be in place for 3 or 4 or 5 years before that bull market, in fact, runs. They also need to recognize that if they aren't in place, they're going to miss a lot of the move waiting to get involved. And I think we're in a circumstance now where global macro favors, as strongly as I've ever seen, a gold bull market. And if past is prologue, the byproduct of that will be a silver market.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 24th through January 31st, 2023, while supplies last. This week we feature 2 different kinds of silver buffalo rounds, at just $2.65 and $2.85 over spot per ounce. First, we have our choice buffalo rounds, silver 1-ounce rounds, 3/9 fine in the traditional buffalo nickel design, minted by our choice of respected private mints. These provide a great way to stack 1-ounce silver at just $2.65 over spot. We also have a new take on the silver buffalo, with 4/9 fine rounds from Bull Mint in Bulgaria. Bull Mint pride themselves on artistry and design, and produce a fine silver round with dueling buffalo on one side and a portrait of a Native American chief on the other. These 4/9 fine rounds are available at $2.85 over spot. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this returning guest. Rick Rule, the former CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Thursday, January 26, 2023. Rick, thanks for coming back on Liberty and Finance.
Dunnigan, it's always a pleasure. I enjoy these sessions.
Our audience always buries me under a pile of incoming questions for you. Today is no exception, so I'm going to try to be very selective in pulling out ones that we can really try to represent them, perhaps the most unasked questions from people in the audience by the ones that we pull as representative. We want to talk about both gold and silver with you today. We want to make sure and talk about the upcoming Silver Investing Bootcamp, the online version of that you're going to be running next month in February, so we will. But first, I want to hit gold because it seems to be on people's minds a lot recently since it's showing such strength in the face of all kinds of other assets rolling over in the last year and quarter. Rowan Abot asks, gold seems to be in a bull market. What economic scenarios or geopolitical scenarios do investors need to be mindful of which might cause the price of gold to fall?
I think the most serious determinant of the gold price is the level of negative real interest rates around U.S. Treasury securities. The most important savings and investment product in the world is the U.S. 10-year Treasury. It's the security that all other securities are priced against. Currently, the arithmetic around the U.S. 10-year Treasury is that it yields you about 3.5% in a currency that the Congressional Budget Office acknowledges is costing you between 7 and 7.5% in purchasing power a year, which is to say that right now, the most important competitor for gold guarantees you a 3.5% annual loss of purchasing power. That's very good for gold over time, and very hard, by the way, on U.S. dollar-denominated savers, to the extent that the Fed was actually successful in engineering a soft landing, which is to say, to the extent that they could keep the interest rate on the U.S. 10-year Treasury at, say, 3.5 or 4, while reducing the rate of inflation to 2, so that the U.S. 10-year Treasury had a positive yield, that would be very bad for the gold price. I would tell the questioner that a circumstance where the nominal interest rate exceeds the CPI stated rate of inflation, and I don't want to get into arguments about the CPI. I don't believe in it either. but the market psychology does. So to the extent that nominal interest rates became real interest rates, gold would have a hard time. If the questioner believes that Congress will balance the budget, then I think you need to be concerned about the gold price. Understand that you are probably only then postponing a gold price increase, because if one assumes that they balance the nominal budget, we still have at the federal level over $100 trillion in recourse liabilities off balance sheet for entitlements: Medicare, Medicaid, veterans benefits, Social Security Trust Fund, federal pensions. But those liabilities in investors' minds are liabilities that they incur in the future, 7 years from now, 8 years from now. If we had a circumstance where the real interest rates, where the nominal interest rates became real, and the predecessor to that, of course, would be balancing the budget, then I think gold investors need to be concerned. Given that that is the circumstance that would cause me to be concerned, sadly, I sleep very well at night with my gold holdings.
You know, you've answered that question in a different way in the past, talking about what will make me sell my gold, and the themes were quite similar. The other question they asked was geopolitical in nature. Is there anything that you're watching out for that would make you think, this may be a game changer that would change the fate of gold going forward?
Well, certainly one of the things that I think has helped gold demand in the last 3 years has been the U.S. government's policy of weaponizing the dollar. The U.S. dollar is still the world's medium of exchange and form of settlement, and the largest asset class for domestic and foreign savers in the world is still the U.S. Treasury market. The United States government has done its very best to debase the franchise that the U.S. dollar enjoys, weaponizing the dollar and at the same time weaponizing the SWIFT banking system. The consequence of that is that other countries and other cultures who don't like the extraterritorial imposition of U.S. policy have begun to store large amounts of gold, with the view both to affecting trade settlements between them and non-U.S. trade parties in gold as opposed to in the dollar, and also because of the value proposition offered up by U.S. treasuries. Imagine yourself running the Chinese central bank. Imagine that you're sitting on a pile of $2 trillion of U.S. treasuries. Imagine, first of all, that you understand that the U.S. government is weaponizing the dollar against you in China, while understanding, too, that the U.S. government is paying you 3.5% in a currency where the purchasing power is falling by 7%. Why would you subsidize somebody who is acting like an avowed enemy? I'm obviously not the only one that's thought this up. If you look at central bank gold purchases around the world, you understand that the weaponization of the U.S. dollar and the lousy investment characteristics of U.S. 10-year treasuries mean that increasingly geopolitical considerations are important in the gold markets.
Still following on this gold theme and the impact that it has on preserving or protecting people from loss of purchasing power, Think for Yourself says, when will pension fund holders come to realize that their portfolios with bonds are losing substantial amounts of purchasing power due to inflation? And when will pension fund managers start to invest in precious metals in order to preserve some of the wealth in their funds?
Well, that's, of course, the $64 trillion question. I personally believe that the next phase of the gold bull market will be kicked off by a disintermediation out of long bonds into gold. Most of the extraordinarily large pools of capital, sovereign wealth funds, pension services, university endowments, are very, very, very long-dated bonds. And for 40 years, that strategy worked for them. As the interest rate fell, the capitalized value of the distributions that they were already enjoying increased. And we had a period of relatively low inflation. That party has changed, Dunnigan, after 40 years. We have a circumstance now where if you have a 30-year bond in your portfolio that you picked up 2 years ago, the capitalized value of your distributions at 1.5% is half. Now that the prevailing worldwide interest rate on a 10-year is 35 basis points. So the principal value of your pension plan has fallen at the same time that the relatively low interest rates that you receive relative to the depreciation of your currency means that the distributions that you will be able to make to your pension holders 20 years from now will buy substantially less than they hope that you would buy. You are truly, as the manager of a very large pension fund, between a rock and a hard place. The capitalized value of your distributions goes down, meaning that your principal goes down. The contributors to the scheme, be they taxpayers or pensioners, don't want to make up the shortfall to the principal. In other words, they don't want to save more now to invest later. And as a consequence of inflation, the purchasing power that beneficiaries are counting on receiving 20 years from now or 25 years from now are being wounded, perhaps mortally, today. Old habits die hard. Pension fund managers have done very well for 40 years owning long bonds. And two, there are statutory incentives for them to do that. If you are a very large pension fund, actuarial rules allow actuarial fraud. If you suggest as a portfolio manager that you own a long bond which you're going to hold to maturity, in most countries, the laws allow you to refrain from marking that bond to market. Because you intend to hold it to maturity, they allow you on a sovereign instrument in particular to carry that bond at par rather than mark that bond to market. So as an example, if you are a holder of long government bonds in the euro sector and you own a 30-year Greek bond or a 30-year Spanish bond or Portuguese bond or Italian bond, and that bond is priced in euros, which is the currency that your fund is denominated in, although that bond in the market might be priced at 50 because of its yield and the relatively low probability of repayment, you're allowed to carry that bond on your balance sheet at 100. That is to say, from my point of view, securities fraud is legal for the very, very, very large pension funds and endowments. The fact that it's legal doesn't mean that it'll have a happy ending for the beneficiaries. And I believe that you will see an increasing trend worldwide for pension fund managers, large endowment managers, to de-emphasize long bonds, which are currently an important part of their investment portfolio. I don't expect to see all of this money flow into gold, but I expect to see enough of it flow into gold to have a dramatic increase in impact on the price. And here's why. The market share of precious metals and precious metals related securities, just in the United States, relative to all the savings and investment assets in the United States, is less than 0.5%. The 4-decade mean is 2%. And it is estimated that at the peak of gold's market share, which was 1971, that the corresponding number was over 6%. So I'm not suggesting that gold will conquer the treasury market. I'm only suggesting that because long bonds represent return-free risk, a guaranteed loss, that enough money will flow out of long bonds into gold that gold's market share will revert to mean. If gold's market share reverted to mean, which is to say 2%, compared to 0.5%, demand for precious metals and precious metal securities in the United States market, the largest savings and investment market in the world, would quadruple. And that's what I think is going to happen.
In the face of that, people are wondering how much gold is actually backing the U.S. dollar compared to what the last audit, which was a long time ago, revealed. Lakeside Bob 1 says, the last audit of the USA gold was in 1956. Since then, and before Nixon closed the gold window, other nations were exchanging paper dollars for gold. Does anyone have an idea how much gold was taken off the gold vaults by foreign nations such as France? And is there any way the quantity of gold in the vaults is still the same as it was in the last audit numbers in 1956?
There is no way to quantify that I know of. Of course, Congressman Ron Paul for years introduced motions to audit the Fed and audit our gold holdings, and his fellows in Congress, be they male or female, always respectfully declined his invitation to allow Americans to understand just how much gold they had in place. But if you assume, just for fun, that the amount of gold in the Treasury is the same as the amount of gold was in the Treasury at the last audit, if you think about the exponential increase in U.S. debt, what you can say is that the collateral, which is to say the gold, relative to the debt, which in this case should include the currency in circulation, the number's infinitesimal. The number's a rounding error.
If we could turn our attention from gold to silver, you've talked with us several times in the past about in the past where precious metals bull markets were characterized by gold moving first and silver moving faster and farther later in the game. People are watching both, and there's a lot of enthusiasm on the part of silver aficionados, but I would like to get your update on whether you think, for example, drawdown of physical silver on the major exchanges in the face of ongoing industrial demand, et cetera, or other factors such as the potential awakening of this latent investment demand that could materialize as it has in the past will drive silver in ways that people haven't seen for some time.
Silver investors need to think about several long-term factors that they seldom think about. Unfortunately, many silver investors are manic depressive, meaning that their attention span is over a long weekend. On the supply side in silver, note first of all that the supply side is undeterminable because many people who own silver would prefer it not to be included in official statistics. But when you look at new mine supply of silver, understand that primary silver production, which is to say production from silver mines, is less than 18% of total supply. Most of the supply comes as a byproduct of producing other metals, copper mines, lead mines, zinc mines, gold mines. And in that case, the outlook for the silver price is very bullish because most of the mines that produce silver are very long of tooth. They're past their peak production. And the mining industry has been really lacking in new project investment for a very, very, very long time. So silver, as an example from byproduct copper production, is set to fall fairly precipitously within 5 years because silver production itself is going to fall precipitously. Similarly, zinc production. I don't think there's been 3 new zinc mines brought in production in the last decade, certainly not a major one. And there are environmental considerations around new lead mines. So over the 5-year time frame, the prospect of new silver production is, I think, very, very grim. And remember that prices are set on the margin. Meanwhile, absent a recession, and I'm not going to say we're not going to have a recession, but absent a recession, demand for silver in industrial processes, fabrication processes grows. Anybody who believes in solar energy, or conversely, anybody who doesn't believe in solar energy, but understands that governments and the big thinkers do, will be relieved to know that silver is an incredibly important component as a reflective agent in the solar industry. Increasing solar penetration means more silver utilization. End of discussion. Stop. What's important to know about silver industrial demand is the incredible efficiency with which silver operates as a germicide. And that means that silver applications around bandaging, around cleaning wounds, around burn cures, but more importantly, around water and wastewater purification, is growing extremely rapidly. So we have a situation in silver where recycling efficiency increases. That increases supply, but new mine supply, byproduct new mine supply, is falling and will begin to fall 4 or 5 years from now fairly precipitously, unless the price goes up a lot, while demand, particularly around solar and biomedical and water remediation, grows fairly importantly. In my experience, Dunnigan, and this is anecdotal, not statistical, none of that matters much in a silver bull market, because a silver bull market really is a momentum-driven, financially driven event. I have now lived through one epic silver market and a couple that were just extraordinary as opposed to epic. And in my experience, the low unit cost of silver means that on a global basis, when the narrative around precious metals has been demonstrated by gold, and gold provides the first part of the momentum, that silver's volatility and silver's low unit cost, the poor man's gold, means that once the momentum has established, leadership passes from gold, from the fear trade, to silver, which is the greed trade. I've experienced this, as I say, 3 times before in my career. And these are truly amazing moves. Some statistics for your younger listeners. The first market that I participated in, the 1970s market, saw silver go from, if my memory serves me well, about $1.25 to $50. I'm not suggesting we're going to get a move like that, but it was something special to watch. The next one saw silver rise from a slightly less lofty base, say about $4.50, ironically, to $50 again. The next one saw silver run from sort of $15 to about $50 again. All of those are nice moves. All of those are nice moves. And all of them are dwarfed by the moves that took place in the silver equities. When the silver narrative takes hold and the generalist investor money tries to crowd itself into the silver equities, there simply isn't enough market capitalization in the silo. And the stocks absolutely blow up. To fuel your listeners' greed and imagination, in my first bull market, Coeur d'Alene mines, which sadly I didn't own, as an 18-year-old couldn't pronounce, went from 10 cents per share to $65 per share. I didn't own it, sadly, so I wasn't a personal participant. But in the next silver bull market, both Silver Standard and Pan American, which I financed personally at 72 and 50 cents respectively, advanced over the 6-year time frame or 7-year time frame, something like that, to prices in excess of $40 per share. The upside volatility in silver for speculators who are patient and have the psychological stamina to suffer through the volatility which is inherent in silver markets is unbelievable. Sadly, many silver bugs, as I say, are manic depressive. If the price of silver from a $24 base rises to $2, they become rhapsodic. If it falls from a $24 base to $22, something's wrong with the world. Something, in fact, is wrong with the psyche of the silver speculator. He or she needs to understand that the circumstances which would set a bull market off can be in place for 3 or 4 or 5 years before that bull market, in fact, runs. They also need to recognize that if they aren't in place, they're going to miss a lot of the move waiting to get involved. And I think we're in a circumstance now where global macro favors, as strongly as I've ever seen, a gold bull market. And if past is prologue, the byproduct of that will be a silver market.
I guess this is a good time to bring up the Silver Investing Bootcamp that you're sponsoring next month. You've been tantalizing us with that term for about a year now, and I kept asking you, well, when is that coming? When is that coming? Last year you did the Uranium Investing Bootcamp. It was 100% online people could just connect in, get the talks, get the recordings and so on at a very affordable cost, which I believe is completely guaranteed to be worth their time or refundable by you if they don't get their value. So no risk to them financially. But now you're talking about a silver investing bootcamp next month, February. What can people look forward to?
Well, Dunnigan, I was so proud of the Uranium Investment Bootcamp. And frankly, I got so much email love afterwards that I wanted to do an educational product around silver that was of the same quality. And it took me a long time to put that together. Those people who attended the Uranium Bootcamp will understand the extraordinary quality of the educational product that we gave them. So investors can expect the same very high quality product. It'll be between 8 and 8.5 hours long, but you'll have access to it for at least 6 months afterwards. So that if you aren't able to sit through 8.5 hours, as an example, or if you need to refresh your memory. By the way, I've replayed the Uranium Investment Bootcamp myself 4 times, despite having known the material well enough that I put it on. That will be available to you. We will start off with an overview of the silver market by the Silver Institute, by the Industry Trade Group. So we'll learn much more about the sources and uses with regards to silver supply and demand. We'll learn about the structure of the silver market, the interplay between physical silver and paper silver, which is in and of itself a really, truly fascinating subject. The fact that 200 or 250 times the amount of silver available for delivery in the silver market trades every day in the futures market. We'll learn about the structure of silver finance. We will learn a lot about the distribution and purchasing of silver, both for jewelry practices and investment practices. So we'll get a good overview of the silver market. Then we will interview a couple of entrepreneurs who have built multi-billion-dollar silver companies from scratch. This is important because the lessons that they learned building those companies will be important lessons for investors who are investing in companies so that they can understand precisely the pitfalls and the opportunities that are involved in taking, say, a silver standard from 72 cents to $45. Bob Quartermain is going to take you through that process. There will be very, very, very high quality silver analysts, which is to say portfolio managers, people who have been involved in the silver industry for 20 years. People who, to paraphrase the movie, have seen the good, the bad, and the ugly in terms of silver equity markets. There will be sponsors, bullion dealers, but by the way, not every bullion dealer. Only bullion dealers that I, in my 40 years of experience, have never had a negative comment or a complaint about. There are good bullion dealers and there are bad bullion dealers. And after 40 years, I think I'm experienced enough to know the difference. And there will also be silver companies. But the qualification to be an exhibitor as a company at my conference isn't merely that your check cashes or that you're pretending to look for silver. I have to know your company well enough that I own it in my portfolio or in a portfolio that I manage. Now, the fact that I own it, sadly, is no guarantee that the price goes up. But it is a guarantee that I've studied it well enough that I'm putting my pocketbook and my reputation at stake. And here's the promise with the Silver Investors Bootcamp: $99 to attend. If for any reason you don't think that we delivered you $99 worth of value, email us and we'll give you your $99 back. We had 3,200 and something people attend the Uranium Investors Bootcamp, and I think that we got 30 requests for refunds, which is to say 1% of the attendees didn't think they got their money's worth. So 100% money back guarantee. If you don't think that you got your $99 worth, the monetary risk is mine.
And also wanted to mention that this summer, you've got another annual Rule Symposium on Natural Resource Investing. This is an in-person event in Boca Raton, Florida, as it was last year. We saw you there and enjoyed being with the exhibitors, the attendees, everybody there, including yourself. Can you tell people what to expect this year in Boca Raton in July?
I think this is maybe our 30th annual conference. I always get the numbers wrong, given that I'm crowding 70 myself. But we've put on the Natural Resources Investment Symposium for a very, very long time. And our goal is simple, to be the best investment conference around natural resources on the planet. Like the Silver Investors Bootcamp, it comes with a 100% ironclad guarantee. If you didn't think you got your money's worth out of the conference, we'll give you your money's back. The idea around the live symposium is very different from the boot camp. This is 4 intensive days, 12 hours a day. Doesn't mean you have to attend for 12 hours a day, but there's 12 hours a day to attend. The idea here is that we bring the best, if you will, gurus in the world to the scene, the Jim Rickards of the world, the Daniela DiMartino Booths of the world, the Jim Grants of the world, the people who can give you the global macro, the economics and the politics of multiple markets where we are today. But then we get to where the rubber meets the road. Again, we have the living legends, people who have built multi-billion-dollar natural resource companies from scratch, to talk about the anatomy of that success and the lessons that they have learned. We have real-time portfolio managers and analysts. We know hundreds of them, and we use the expertise gained through interacting with them over 40 years to try to select for our attendees the best of the best. In this product, like in the virtual products, the exhibitors present can only be exhibitors if they are owned in the accounts owned or managed by the conference presenters, which is to say, in the case of every public company exhibitor, we have to own them. We will interview for you every single exhibitor. There will be workshops that you can attend. We're arranging one-on-one discussions. So if you want further information from an exhibitor and you don't want to ask the question in the presence of 500 of your closest friends, we will arrange for you to have the opportunity one-on-one to talk about that investment process. And importantly, what I've learned over 30 years of putting on this conference is that you have an awful lot to learn from your fellow attendees and from the gurus. I remember 4 years ago myself following Robert Friedland around the exhibit floor, paying attention to what companies a billionaire investor was asking questions to and listening to what questions and what answers. The idea that there are 500 or 600 applied high net worth investors in the crowd means that not all the knowledge is going to flow from the dais to the crowd. The interplay between the crowd, be it on our attendee boat cruise at night, be it at one of the sponsored breakfasts or lunches, the ability to interact with fellow investors and participate with fellow investors in question and answer sessions with the gurus, with the analysts, with the portfolio managers, and with the exhibitors makes what I truly believe is a priceless experience. I should also say, people question my sanity for having an investment conference in July at Boca Raton, Florida, not really known for its spectacular weather at that time of year. We're having this at the Boca Resort, a $1.4 billion resort set on 24 acres in Boca Raton with almost half a mile of beach. During prime time, the rooms at this hotel go for $1,100 a night. Because we have the event in July, this same wonderful resort is available to our attendees for $290 a night. I assure you that the air conditioning in your room will work. I assure you that the air conditioning in the conference is such that you will be extremely comfortable. And I assure you, too, that after the conference is over at 8 o'clock or 9 o'clock at night, as you retire to one of the delightful restaurants in the resort, including outside on the patios, that you will have a spectacular time. Spectacular time.
I was just thinking, painting memory pictures for me. Last July, there is a particular fine dining restaurant overlooking the beach that you mentioned, and this is the third time we ate there during the week that we were there. We had their baklava dessert, and we've had baklava everywhere, but never like that, where both the manager and the waiter show up at the same time and do this special assembly of it at your table, and with the ice cream and the caramel sauce and everything. It's just like, yeah, there was a lot of fond memories of the exquisite resort there. Even playing mini golf with our grandchildren out there on the mini golf course.
It's important, Dunnigan, that your listeners understand that the primary part of the value proposition is the education that they get at the conference. But the physical aspects need to be as attractive as possible. When we polled the attendees at last year's conference, asking them if they wanted to be in Boca or back in Vancouver would have been more convenient for me. The attendees overwhelmingly said that the amenities around Boca in the hotel were so superb, and also access to South Florida for our international attendees from South America or Europe, flying into the wonderful airport infrastructure in South Florida, just means that the overall conference experience at Boca Raton is superior for us.
Well, we're going to put links to both the Silver Investing Bootcamp, which is online only, so you don't have to do any travel for that one, guys, and it's only $99. A link to that registration in the description of this video, so go there right after we're done here and sign up for that one. And also a link so you can sign up for the Boca in-person conference in July in Boca Raton, Florida, and that's also in the description of this video. Either of those, you'll be able to help support our channel by registering. And Rick, as always, we wanted to give you a chance to see if you want to re-up your offer to rank people's investment portfolios.
I absolutely do, and thank you for that opportunity, Dunnigan. We've now ranked over 80,000 portfolios in the last few years. That's how I age so quickly. And the offer goes like this, ladies and gentlemen. If you care what I have to say and what I think about natural resources, I can personalize it for you. Go to ruleinvestmentmedia.com. Enter your natural resource portfolio. Please, by the way, no tech stocks. Please, no pot stocks. Please, no crypto. Just ask me questions about something I understand. I'll rank those companies if I know them, 1 to 10, 1 being best, 10 being worst. And I will comment on individual issues if I think my comment have any value. In addition to that, because I'm now allegedly retired, any of you who care about what I do with my own money by way of private placements, if you are accredited, can ask to be put in a list where I give you notification of the private placements I participate in. There's no charge to you. There's no charge to the company. This is completely free. In the question and comments section, write placements. Finally, I'm celebrating retirement by starting a new bank, Battle Bank, the successor to EverBank, which many of you were customers of. If you care about information around a real bank, a new bank, a bank that has money in it, a bank that will pay you in the highest quartile of interest deposits, a bank that will allow you to own single-family or multifamily properties in your IRA legally, a bank that will loan you money against your precious metals holdings to buy more precious metals, or a bank that will allow you to own CDs denominated in foreign currencies. In the question and comment section at Rule Investment Media, write bank. The name of the bank is Battle Bank, as in we are battling for better banking and we're battling for your banking business. Thank you for the opportunity for that, Dunnigan. It's rankings, placements, bank.
And as always, folks, make sure that you take the opportunity to sign up for our free newsletter so that you don't miss a single episode with Rick or any of our other guests. Just go to libertyandfinance.com, put your name, your email address, click submit. Make sure you confirm on the confirming email and you're in. 1 email per day in your inbox with our latest interview and our weekly specials. Rick, as always, on behalf of our viewers, just thank you for joining us here on Liberty and Finance.
Always a pleasure, Dunnigan. I look forward to seeing you at the Silver Bootcamp, and I look forward to taking you and your family out for a cocktail on the boat cruise at the Boca Raton Conference. It was a high point of my year last year, so thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded. and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.